Welcome to the International Center at the University of Michigan's U.S. Federal Income Tax webinar. The University of Michigan's International Center provides its F&J visa holders with free access to the user-friendly income tax form preparation software called Syntax. While Syntax does not require that its users have an in-depth understanding of the U.S. income tax process before they can successfully prepare their tax forms, we have designed this webinar for those F&J visa holders who wish to know more about the U.S. income tax process and how it applies to them. Please do not mistake the following information for tax advice. Welcome to Part 2 of the Federal Income Tax webinar for F&J visa holders. In Part 2, I will discuss deductions, exemptions, and credits, as well as common tax treaty benefits and the tax withholding process. If you're interested in learning more about filing requirements, such as selecting forms, filing status, and/or deadlines and addresses, please move on to Part 3. Thank you. In this first chapter, I will talk about deductions, exemptions, and tax credits. There are two main ways of claiming a deduction on your tax return. You can claim a standard deduction, or you can claim an itemized deduction. The standard deduction is a fixed dollar amount that reduces the amount of income on which you are taxed. Individuals who claim the standard deduction cannot also itemize deductions. It is important to know that resident aliens can claim the standard deduction, or they can itemize their deductions using Schedule A of Form 1040. They cannot do both. For additional information on this, see Publication 501, page 25 on the IRS website. And as an aside, remember that when I mention resident and non-resident aliens in this webinar, I mean residency for tax purposes, and I explained what that meant in Part 1 of the webinar. With the exception of some students and business apprentices from India, non-resident aliens cannot claim the standard deduction. Non-resident aliens are also limited to a few itemized deductions, including payments for state and local tax, contributions made to U.S. charitable organizations, and/or casualty or theft losses. For more on this, see IRS Publication 519, pages 28 through 30 on the IRS website. Exemptions, like deductions, reduce one's taxable income by a fixed amount. There are also two types of exemptions, personal and dependent. Personal exemptions are those taken for oneself or for one's spouse if one is married. Dependent exemptions are generally claimed by filers with qualifying children or relatives. Whether or not you have a qualifying child or relative can be determined by looking in Publication 501. Now, the IRS will treat resident aliens and non-resident aliens in this area differently. Resident aliens may claim personal and dependent exemptions in the same way a U.S. citizen can claim them. Non-resident aliens may only claim one personal exemption. This means one exemption for yourself only, and no exemption for your spouse. Non-resident aliens are also unable to claim exemptions for dependents unless you are a resident of South Korea, Canada, Mexico, or India, and you meet the additional eligibility requirements. For more information, see pages 27 and 28 in Publication 519. Tax credits, unlike deductions and exemptions, lowers the tax one must pay, instead of simply reducing one's taxable income. Again, resident aliens and non-resident aliens are treated differently. Resident aliens are eligible for the tax credits as U.S. citizens are, while non-resident aliens can claim very few credits. And most non-residents are not eligible to claim those credits. To learn more about this, see pages 30 through 32 of IRS Publication 519. In Chapter 2, I will talk about the common benefits of tax treaties. The U.S. has tax treaties with many countries. As a result, residents of these countries may reduce or eliminate their U.S. tax liability by claiming treaty benefits. Most tax treaties include savings clauses, which restrict benefit eligibility to non-residents of the U.S. Still, some treaties provide specific exceptions to their savings clauses and allow for some resident aliens of the U.S. to benefit. For more information about claiming treaty benefits, please look on the International Center's website under Tax Treaties, which is under Non-Resident Aliens, or look in Publication 901 on the IRS website for quick reference to tax treaty benefits by country. Sometimes an individual can become a resident of more than one country at a time if she or he qualifies as a tax resident under both countries' laws. Treaties have tiebreaker provisions, but can be applied to break the residency tie should that happen. Each treaty has unique eligibility criteria. Most treaty benefits are activity-specific, and one's original and primary purpose for coming to the U.S. must be an activity listed in the treaty in order for that individual to claim the benefit. Changes in status can make an individual ineligible to claim a benefit, since one's primary activity within the U.S. often changes as a result. Lastly, treaties frequently limit the number of years one can claim a particular benefit, as well as the total amount one can claim. Some common activities for which tax treaties reduce income tax obligations include wages received in exchange for personal services, wages paid to visiting teachers, professors, and researchers, and funding received by students, apprentices, or trainees paid from abroad for maintenance or for their studies if they are in the U.S. to study or to acquire technical skills. The final chapter in Part 2 covers the income tax withholding process. As discussed in Webinar Part 1, the U.S. has a pay-as-you-go tax system. Employers withhold income from each pay period before paying employees. This slide illustrates in detail how withholding taxes from earned income works. First, if you are an AFRA-J visa holder and you accept a job from an employer, the employer will request that you complete a tax withholding form. This form will give the employer an idea of how much tax to estimate as your withholding. They will then withhold that estimated amount from each paycheck and indicate on your pay stub the total amount of money you earned minus the amount that was paid to the IRS as estimated tax. The employer will then pay the estimated amount to the IRS. Then, at the start of the next year, they will notify the IRS how much was withheld from your paycheck in total from the previous year, and send you a copy of that information in the form of a W-2. You will use your W-2 form to calculate your taxes and prepare your tax return. In addition to the withholding report, or the W-2, you will also indicate the other types of income that you received during the year. Then you will mail your tax return, including the withholding information and perhaps other information, to the IRS. You may or may not be including a check. The IRS will then review the return to make sure it is correct and either issue you a refund or cash your check. Foreign payees and employees should notify their employers and payers of their residency status so the correct amount of tax can be withheld. The University of Michigan's payroll office will ask you to complete the Alien Certificate form, for example, in order for them to make this determination. As for wages, resident aliens and non-resident aliens are subject to withholding at graduated rates. With respect to unearned income, resident aliens are not subject to withholding, but non-resident aliens are. Unearned income for non-resident aliens is generally withheld at a flat rate of 30%. Both unearned and earned income tax for non-resident aliens may then be further reduced by tax treaties. For U.S. citizens and resident aliens, scholarship and/or fellowship income need not be reported by the payer to the IRS. It is generally not subject to withholding. The recipient, however, is obligated to report it and pay any tax that is owed. If a scholarship or fellowship grant is for a degree candidate and for qualified education expenses only, no amount is withheld and no reporting is necessary. This rule applies to non-resident and resident aliens alike. If the scholarship or fellowship is paid on the condition that the individual perform personal services in exchange, such as research or teaching, it is treated like wages. It will be reportable and subject to graduated withholding. This is true regardless of whether one is a U.S. citizen, a resident, or non-resident alien. Scholarship or fellowship funds paid to non-resident aliens in F1 or J1 status for unqualified education expenses must be reported and is withheld by the payer at a rate of 14%. The withholding form or forms you will be asked to complete by your employer or payer depends in large part upon your residency status and the type of income you are receiving. Your employer or payer should provide you with the appropriate withholding form or forms as follows. Resident aliens who earn wages will be asked to complete Form W-4. Non-resident aliens who earn wages will also be asked to complete Form W-4. This includes individuals who receive scholarship or fellowship funds that require the individual to perform a service in exchange for the funding. For example, teaching a class. The appropriate set of instructions for completing Form W-4 for non-resident aliens differs from those appropriate for U.S. citizens, so please be sure to fill out the form properly. Non-resident aliens who claim treaty benefits for wages earned should complete Form 8233. If a non-resident alien claims treaty benefits for a taxable scholarship or fellowship fund, she or he should complete Form W-8-BEN. We will discuss which forms you will receive from your employer at the beginning of the next year in Part 3 of this webinar. In addition to the federal withholding, taxpayers are generally subject to Social Security and Medicare tax withholding. This is also known as FICA withholding. F1 and J1 status holders who are non-resident aliens are not eligible to receive benefits from the Medicare or Social Security program based upon employment performed in connection with their immigration status. No FICA taxes should be withheld from wages earned if they are earned in conjunction with such status. Specifically, this includes on-campus employment, practical training such as curricular, optional, or academic, or authorized off-campus employment. This exemption from FICA withholding only applies to non-resident alien F1 and J1 status holders, J2 dependents, for example, who are authorized to work, and resident aliens in F1 and J1 status are subject to FICA withholding. However, because all student employees who are enrolled full-time are also exempt from FICA withholding, and because international students must generally be enrolled full-time in order to comply with their immigration status, the FICA withholding exemption period may actually continue to apply to students even after they become a resident for tax purposes. Be aware, however, that any time the student is not enrolled full-time, for example during summer, this exception would not continue to apply. What should you do if you believe FICA tax was withheld in error? Well, if you believe that you've had these FICA taxes withheld from your wages in error, the first thing you should do is contact your employer to see if they will refund your money. If they are unable or unwilling to do so, the next step is to obtain Form 843 from the IRS website. You should complete this form and then submit it to the IRS. The mailing address for the form is listed on the form's instructions. I have now completed part 2 of the webinar. I hope that you have found the information I have provided helpful. If you are interested in learning about filing requirements such as filing status, form selection, and addresses or deadlines, please move on to part 3. Thank you.